The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday the 8th of January 2021. On the podcast today, Wendy Lawrence, CEO of Totally PLC, gives a roundup on 2020 and talks about expectations for 2021. Plus, Paul Hill, full-time investor and equity analyst, gives his view on the need for more COVID testing for longer. And we discuss stocks worth following, including Novacyt, SourceBio, easyJet, Ryanair, Wizz, Equals, Ilika and Escape Hunt. Plus, Russ Mould, investment director at stockbroker AJ Bell, talks about oil companies, the recovery and stock market versus the real economy. Plus, as always, I have two lists for you. The top 5 most followed companies on Vox Markets in the last 24 hours and the top 5 most read RNSs too. Plus, if you go to voxmarkets.co.uk, which you'll see those lists there, you'll see other content. In fact, there's an article there on pets at home. There's one there on ITM Power and 88 Energy and Alba Minerals. And of course, you can see our COVID-19 index there. And let's have a look there. E-Therapeutics is the biggest rise today, up 7% to 19 pence. Biggest faller, Waite Education, down 4 points. In fact, just flipped. Avacta is the biggest faller there. In fact, it's gone back. It's Waite Education and Avacta. So check that out. Down both about 4.5% right there. Check that out. voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Wendy Lawrence, CEO of Totally PLC at TLY ticker. Wendy, Happy New Year. Thanks for joining me.
Yes, good morning. Thank you. Thanks for having us on the show again.
Yeah, well, do you know what? It'll be good to get a reflection of 2020 from your perspective, because I know you're probably close to the front line than most people listening, unless they work in the NHS, of course. And it was a totally mad year for everyone, but you would have seen the actual real impact of that, I suppose. So we'll dig into that and we'll have a look forward to this year as well. But before we do that, if someone's sitting there thinking, oh, it'll be interesting, but don't know what the company is, can you explain what Totally does, please, Wendy?
Yes, of course. Totally is a provider of healthcare services, and typically we work in partnership with the NHS. We work across the UK and in the Republic of Ireland and provide services where demand increases across the NHS and where they need support from organisations like Totally. So a whole range of healthcare services on the front line.
Excellent stuff. Okay, so take us through it then. 2020, and when did you start realising? I remember going to Centre Parks in like February last year. I mean, there was a rumour of this virus going around, but we hadn't had the impact of that. Were you sort of aware, or did you know it was going to become big, or when did you first realise that, this is going to affect the business, we're going to change this, or we're going to do this, we're going to be very busy? Did that catch on at any time? Was it quite early or midway through the year, or when?
Yeah, we were talking about this actually, Justin, just a couple of days ago. So it was in a few weeks' time, a year ago, we started to notice that demand across the 111 services were increasing and increasing above what we would normally expect at that time of year, because we do profile activity, there are ups and downs all year. So we knew something was happening. And yes, there were rumours around about virus, and certainly the people that were contacting us at that time were explaining a range of symptoms that were different to anything that we'd experienced before. So around the end of January, up until the middle of February, we saw this slow increase. For us, it really started to bite from mid-February onwards. And to be very honest with you, apart from a slight lull over the summer where when the first lockdown ended, and things started to look a little bit more in control, it's pretty much continued to be very high demand for us during the whole period.
Yeah. And what's it been like? I mean, are you quite happy with the way you've dealt with it? Because it's unprecedented and you can't forecast what's going to be thrown at you. But are you quite happy with the way it's panned out? I mean, from a corporate point of view, I mean.
Oh, from a business point of view, I mean, I'm thrilled with not only how our staff have responded, but also how as a business we've been able to flex what we do to respond to something that nobody expected. So we work in 3 divisions. Our urgent care division is the biggest. So 95% of our revenues sit in urgent care, and that's where we provide 111 services, GP out of hours, the urgent treatment centre work, and literally work alongside the NHS to deliver service. So what we've seen during that time is, business as usual across all of those, and then adding on all of the services that we've responded to the call from the NHS to help them with for managing coronavirus, and completely changed the way we do business, whether that be in 111 and having to protect our staff and work in a different way by the provision of PPE and changing call centre layout and recruiting additional staff, of course, because of the increases in demand, or whether, changing the pathways when we're seeing patients face to face to ensure that patients are safe and our clinicians are safe. So it's been a challenge, but we should be very proud about what we've done. We've provided additional services continually. We continue to do so now, that are there particularly to manage coronavirus. And whenever the NHS has contacted us to say, can you do this? We've done our best to support them. And at the same time, making sure that the quality of the service remains high. And, before Christmas, we had a CQC inspection, the Care Quality Commission inspection, that has resulted in all of our services now being rated as good by the Care Quality Commission. And to do that at the same time as increasing, what you do is really pleasing for us as a business. Yeah. The outdrops of coronavirus, of course, also mean that a lot of work that the NHS would traditionally do, so waiting list management and all of your elective planned care, has been on hold. And certainly during lockdown 1 and lockdown 2, elective care was suspended. And that impacted on us as business. We had 2 divisions that couldn't work during those periods. But those waiting lists have increased exponentially. So now we see great demand for service on our insourcing business, which is the part of the business that works in hospitals, typically over the weekend, using hospital operating theatres, hospital equipment. We take staff in to reduce waiting lists. The demand for that service is high, and it's really key. At this time of me speaking to you, those services are still continuing. So where we have been working in Ireland and Scotland and England, since the end of lockdown 2, so since October onwards, those services continue. So the NHS is doing its very best to reduce that waiting list position. So I expect the pressure on insourcing to grow and grow and grow. So it really is a mixed bag, Justin, but continues to be very busy. Yeah,
well, good. And like I said, for this year, it's hard to predict anything. We know that now, being reminded by coronavirus, that forecasting is very hard. But if you did look forward, say 6-12 months further out, maybe, what's your thoughts for the business?
Yeah, it's difficult, isn't it, to forecast anything that's going to happen at the moment. And you'll know that in June last year, when we put our results out, which were very, very good, we removed our forecasts from the market, and I can't see that changing anytime soon, really, because again, we don't know what's happening. The way we do business has changed. The NHS is not tendering services as they were before for us to grow massively. But what we are seeing is, and again, we've put these out to the market, we're seeing all of our contracts being extended for 6 to 12 months, generally 12-month extensions going forward. So our revenue base is very secure. We are growing, but we're growing through smaller pieces of work rather than these massive new urgent treatment centres. I think that's going to continue for some time yet. I can't see us getting any less busy. And, I think we are going to deliver above and beyond what we might have thought this time last year, because I don't think anybody sat here last year thinking we would still be in, managing the pandemic and in the 3rd lockdown. Yeah. The vaccination programme, I think, offers hope for everybody that we will be able to get back to some kind of business as usual. But obviously we've got the challenge right now to make sure that the vaccination programme is delivered and we can get back to, some kind of what is the new normal, what is the new normal going forward. So I think that's where we're concentrating on as a business.
Yeah, excellent, absolutely. Marvellous stuff. Okay, Wendy, well, if someone's listened to this and likes the sound of what you're doing there but are not yet following the story, please give them 3 quick reasons why they should add Totally to their watch list, please. Okay,
so I'm very proud of what we've done, and I think we are unique as a listed company in terms of how we work shoulder to shoulder with the NHS and the wider public sector delivering service, and the demand for our services continue to increase. What we do is very high quality, so I think our reputation is such that we can expect to be that partner of choice for the NHS going forward. And we are one business out of very, very few, I believe, that are going to show good results for our shareholders going forward. And, the support of them is urging us on to actually do more of what we know that we do very well.
Yeah. Marvellous stuff. Wendy, thanks for catching up with us, and hopefully we'll catch up in the not too distant future. Thanks very much.
Thanks very much, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now and live on video as well. By the way, if you want it on video, subscribe, hit that notification bell, and you get Paul Hill, full-time equity analyst, full-time investor. You all right, fella?
Yeah, Happy New Year, Justin, and morning.
Yeah, Happy New Year. The market started off a bit dodgy for me for the first few days, but it's getting better. Yesterday and today, it's getting better, I find. And I know the banks, I don't hold any banks, but I know you hold some banks. But I've seen HSBC yesterday, the stock market, the FTSE was up by about close to 4%. A lot of that was down to oil. But didn't the banks rally as well?
Yeah, absolutely. I mean, a lot of it was down to what had been happening over in the States, because we've had that Democrat sweep in Congress. Yeah. They've overturned the Republicans in Georgia. It's meant that actually, the investors are thinking there's going to be one massive mother of all stimulus plan when Joe Biden comes in a couple of weeks, and we're going to get through this sort of like difficult third wave of the coronavirus, and therefore you've actually seen the US 10-year Treasury steepening, which means that banks make more money now because they borrow at sort of like 0% and can lend at 1%. It's the first time it's gone above 1% for almost 12 months. And what's actually happening is that, that's going to be good for the US banks, but also investors are thinking, look, the US is sort of 6 months ahead of the rest of the world, and it's going to happen also in the UK. So that's why the banks rallied. And the other thing you also get is if you're going to get massive amounts of money printing and stimulus out in the US, then the dollar's going to continue to weaken, and that's what boosted a lot of the actual oil stocks, along with OPEC or Saudi Arabia saying they're going to keep tight on the oil market. Yeah. So it's quite an interesting play actually, because what that means is that what we've discussed about that whole recovery play, even though the next 3 to 6 months might be a bit tricky. It means when we get to the second half, assuming this third strain doesn't mutate its spike protein such that it can circumnavigate the vaccine efficiency, assuming that's not the case, which would be a total black swan because it would mean we'd have another pandemic, then we should have a roaring, and they've been always saying this for some time, a roaring 20s again, which was like 100 years ago.
Yeah. And talking about macro, like you said, but on the old vaccine thing, I think I was listening to the guy who's head, I can't pronounce the name unfortunately, but he's vaccine minister, and he was very confident yesterday. He was doing the rounds on talks, on all the talk shows and all the breakfast shows and all that stuff, and he was saying it does 13 million doses seems like a massive target, and it is. It's the biggest vaccination program we've ever seen in the NHS ever, but we do have the network there now with AstraZeneca, and Oxford of course only needs to be refrigerated in GPs, and they all have those kind of fridges. He said, and we've got a network there. We're getting GPs up this week. He said from Monday to Monday you'll see a massive uplift in vaccinations, and the Monday after, because then we go into pharmacies, and but he reckons he's confident that we'll get, and that's about it. I did the maths yesterday. So they've done 1.3 already million people, and they're hoping to get 13 million by mid-Feb. That's 300,000 a day exactly. And so, but he's quite confident they'll do that. And I think I was looking at, I'm charting at the moment, keeping an eye on hospital admissions, COVID-related, and that's really topping out. We're at levels now, because there's no point looking at deaths. Deaths actually coming down, because we're dealing with it a lot better. And but if you look at hospital admissions, it's going up and it's peaking towards 3,000 people. I think it was yesterday, which was close to the peak back in March. But it takes about a month, even with the lockdown. It takes about I know this is not a harder lockdown as last time, but if you look at the chart there, it took about a month from the peak to coming back down. So it's from mid-April to mid-May, it started coming back down the other side. But with the vaccine as well.
So you reckon sort of by the end of January, then we should be in a better position?
Yeah, well, you've got, hopefully.
So you reckon by the end of January we should be...
Yeah, this variant is saying is it's more contagious. But with the lockdown and the vaccines, I think towards the end of January we're going to start to see those figures coming down. I think, and then like I said, mid-Feb. I mean, stock markets always work ahead. So I think once people see those figures start coming down, I think stocks, especially the stocks have been hammered. The leisure, the hospitality, the travel stocks, even banks, I think will start to rally. And then we may have a decent. Nothing ever goes according to plan. Though we're all thinking, 2021 is going to be a massive rally year. There's going to be something go wrong. It can't just. I saw a comedian saying, 2021 is the exact opposite of 2020. We started off in 2020 with 3 good months, then a rubbish year, and then this year's going to be 3 bad months, then a good year. But we'll see. I mean, hopefully that's the way it plays out. Who knows? You can't second guess stock market, really, can you? So, but hopefully that's the way it plays out.
And also the other thing to add is that single shot strategy that they've decided to do, i.e., to inoculate as many people as possible first off the bat and then wait for 12 weeks seems to be a perfect strategy, because if the trial data comes through that effectively the efficiency is 100% for stopping people going, for hospital admissions, and that's what it was in the trial data when they did a 30,000, phase 3 trials, then that means by inoculating somebody just with that single shot, you actually stop them going into hospital, which is really the key sort of like logjam for the NHS. And I think your timescales are perfect. I mean, I'm working off to the same sort of thing. Give the lockdown a bit of a chance. Hopefully we can get it under control by the end of January. The economy can still relatively tick along, other than those ones which are really sort of like hit badly. Yeah. And once we've actually, I think the target is 25 to 32 million people to be vaccinated by spring. And if that occurs, and it's most of those which are vulnerable, then, hey, the schools can go back and universities can go back and we can all start enjoying ourselves.
Yeah. I think there's a difference between people saying, well, it won't be till the end of summer till we're all vaccinated. But we don't need to be all vaccinated. That's the thing. It's affecting a lot of people. But the people that are taking up the beds are those vulnerable groups. And once you protect those, then we can, the NHS is protected then, and so we can open the economy. That's why we're locked down, So, I think, honestly, within 2 weeks, we should have hit the peak, because, after 2 weeks of lockdown, obviously, it takes for that long to transmit, and, of course, over the summer, over the Christmas holidays and stuff. So, yeah, hopefully. But, what's odd, though, looking around the world, it's the vaccine race now, and I think Boris Johnson is trying his best to win something here on COVID, and so if he can win this vaccine race against every other country, he can say, listen, I did something positive during this pandemic, because let's be honest, he's behind the curve on pretty much everything. He said it was safe to go to schools. I want to know what changed in that day. On Monday, safe to go into schools, 8 p.m. Don't go into schools. What information do you have that changed it so radically?
I don't think he was actually saying schools. I think what he was actually saying, it was that secondary transmission, and it was that third strain, the South African strain. What is quite important, I think, as well, is that a lot of investors who are following this also hold COVID testing stocks. And what that means, this new strain, it's not only super contagious, but actually it's ultra fast mutating as well. 23 variants have already, and there's thousands around the world. So what that means, if you think about it, is such that going forward, we're going to need an ultra sensitive alarm system across the world. Whenever we get a South African variant, we need to be able to respond, sequence it, and tweak the vaccine if we can, super quick. That means you're going to continue to have mass testing of the population, and probably both antigen and antibody, because antibody testing is going to be needed as that vaccination passport. So this whole sort of doom cycle that there's going to be no testing going forward is just not going to happen. We're going to see, because of the super fast mutations, which was not built into most people's models, and certainly wasn't built into mine for coronavirus 6 months ago, means that we're going to need a lot of heavy lifting on that testing to provide the authorities with quick fire response that they can then adjust the vaccines to make sure that we... Justin?
Yeah. Sorry, you dipped out then. Yeah, absolutely. And no, I think that's true. What I said with caution to people who are investing in COVID stocks to just do COVID testing, if they haven't got commercial contracts right now, that's quite worrying, I think, because the NHS, I think, they have their preferred supplier list and all that stuff, and if they're not already have a contract from the NHS and other people, then that's quite worrying, I think. And if that's the only play they have, then that's a bit worrying. Because I think the sentiment plays a lot of, big part in the markets. And like I said, they rallied, those COVID stocks were super hot when we realised we need to test. We need to test. Testing until we get a vaccine, that's all we have is testing. And now we have a vaccine, it's a two-pronged approach. So the heat has gone out of testing stocks a little bit. So unless you have that, that revenue coming in, it's a bit worrying because there are some stocks that they're still hoping to get contracts. And I'm thinking, they're leaving a bit late because there are other companies doing well. Like Novacyt, for example, is doing very well. I think SourceBio as well. But those guys have contracts already and they're doing quite well already. So the others may get left behind, So and also, they've got to have a different... If there's one approach strategy, that's COVID testing, it's a bit worrying if that falls over. They've got something else to go with it.
I agree. To be back in a few more horses, then it's always good and get a bit of diversification and spread. Just on that, and also on the sort of the macro side, I think, again, I'd point investors, because I was absolutely privileged to host...
I was going to say, I took my macro list.
This macro investing masterclass with James Bevan, James Athey, who's a bond guy, and Colin McLean, who are real heavy hitters in the fund managing industry. And what you learn from those guys is as much about how their brains work, because it's just, the super high level in terms of top down and, sort of understanding the macro and asset allocation, but also very much detailed and from the bottom up and distilling that sort of... I recommend investors just watch it because, I was fascinated and I've been investing for sort of 30 odd years. And the key takeaways that I had was that the big sort of like trends for this year to watch for was certainly continued dollar weakness. And that's going to be mega in terms of boosting potentially boosting emerging markets, because you saw that sort of 15 years ago as the dollar weakened, you had that huge carry trade. And that will lead to inflation, hence the whole recovery. You've got a sort of the still steepening yield curve, which again will be boosting inflation. And these guys were actually saying start to think about, and they're already doing it just in their portfolios, into these rotations. So you had people talking about you had Colin suggesting going into the low cost airlines. I know you'd gone into easyJet sometime. They were saying sort of Ryanair and Wizz Air. Also the house builders. You had James Bevan talking about the US banks, because they were up sort of like 8 or 9% last year. So it's a really fascinating way for investors, if you're not familiar with it, looking at the top level, bringing that macro sort of bird's eye view and then dovetailing it with the ultra detailed stock picking, the kind of stuff that you do every day, Justin, and it gives you that confidence that the backdrop is supportive for these businesses to do really well. So I would recommend... I've watched it actually twice, and I hosted in it just because I found it that interesting. You learn so much from these guys.
Do you sit there thinking, I'm looking very good there?
No, I certainly don't say that.
Sharp.
But it's because these guys use, they say things in a sentence, and actually, then you start thinking about what they actually mean, and it can go straight over your head. But the second time and third time you watch it, it's like watching a really good film,
Yeah. Well, no, these guys, they've done it all their lives. They're super professionals, aren't they? They're guys out there who invest, but these guys, have done it very well. And so you have to pay attention to what they're looking at, and you learn from it, And like I said, I think I've never been so conscious really in the last couple of years as to sectors and trends. And I think, when you're in a good trend, all boats will rise there. And especially now, there are certain sectors that have been hammered in this COVID, and they haven't recovered. So, there's still plenty of time to jump in. And at the moment, one of the ones I keep banging on about, that obviously people, oddly, the average private investor will only jump on a share price once it's risen. Once it's risen, it gets a lot of heat, gets a lot of coverage generally on social media, and then people jump in. But you've got to understand, it's best to do the research beforehand and, form your opinion before everyone else and get in there and then just wait. Just wait for the tide to rise. Because, and I've been banging about escaping for a while because they've just done now.
One of those.
No, I'm just saying it's a leisure stock. They've just got money from the Chancellor. They've raised money anyway, so they're okay for cash. They're burning very little. They've got furloughed staff. But they've also come out with this digital strategy that basically they did even one game in December. Right? First of all, they did was it 1,000 games, corporate games, pretty much. 6,000 people took part. But in one game, they doubled their physical site footprint. In one game, they hosted one game with 350 people in it, and it was across 2 nations. I thought, that's 57 games, which is pretty much as many rooms as they have around the UK. And I thought, if they can do that, that is a blue sky opportunity. So there's that. There's also the fact there's leisure. There's also the fact now that their physical site has increased by 36% since their lockdown. And even then they had like-for-like sales up 55% before the lockdown happened. So it's a growing company, and there's some leverage to the open economy. But now they have a digital side to them. But of course, because the share price hasn't gone berserk, then people don't jump in. But once the share price goes berserk, that's a bit late, So trend
sort of like just illustrating that strategy of getting in early is equals, because yesterday you put out a really positive trading update, and I know I've been banging the table about this one before, but it has reached, and it demonstrated it yesterday. It's reached a tipping point. It moved into EBITDA profitability, and what actually happened is that its revenue went up by effectively a million more than expectations, but its profits, its EBITDA, doubled off the back of it almost. And what you saw was huge operating leverage. So it's going now through. It's the archetypal platform stock with 60-odd% gross margins, EBITDA drop-throughs of sort of 45%, as you put it, and so every incremental pound you put on the top line, you're going to get about 45p coming through to the bottom. Next year, they've just come through a really tough period. I think you spoke to Ian Strafford-Taylor yesterday.
It was a tough period in a tough period. So they've come through, exactly more bullish than they ever thought they would, or done better than they ever thought they would. Yeah, and now there's, like I said, it's a very similar analogy to the general economy, light at the end of the tunnel here, but it's lining up for them well, isn't it?
But the key thing, if the investors take one thing away for Equals, it is a bank grade technology platform, and I underline the word platform because what that means is every single incremental pound is going to get 45p drop down to the bottom line. You saw it yesterday with the trading update. Now they might well have a sticky first 3 months because their comparatives are really tough because they had a booming first 3 months in 2020. But given that, afterwards, it's going to absolutely race. And this B2B play in the SME sector is pretty damn unique. And we just proved it because they signed that contract with HomeSend, I think it was in November. And that's a joint venture with MasterCard, who wanted to use their platform to basically do business-to-business payments in the UK. Yeah. I mean, it's phenomenal, absolutely phenomenal. If Ian and Richard, who's the CFO, can carry on generating that top line, you're going to see a money machine here, and it's still only. I mean, is it 32p? I mean, I put a conservative valuation. I upgraded to about 67, and it still wouldn't be expensive. So I would say, if you haven't had a good look at it, kick the tyres on this potential. This is a high operationally geared, effectively profit machine for every incremental pound, and it demonstrated that yesterday with its trading update. And the other thing which is really good is that even though they're starting to the tip point, you probably got the indication yesterday when you spoke to Ian. They've really got their finger on the pulse to come out with profits and sales 2 days after the period closed, trading days. It just tells me that they really have a firm grip of that business and all its costs. And the headcount's down by 25%. They are absolutely nailing what the operations of the business and the revenue side. If you have an increasing revenue, a reducing cost line, that only means one thing. It's going to go, the profits are going, and the cash is going to increase.
Well, no, exactly. The point that he said yesterday, he said, it's one thing to cut costs, but if your revenue is going down, it doesn't do anything. So we are, the revenue's gone up, and we're cutting costs as well. Yeah. So it's definitely heading in the right direction. What's nice though is you did some deep research on that a couple of months back, wasn't it? And probably 4 or 5 months back now, I suppose. But and when you do research and you see things changing for the positive in something. But you'd only see that if you did some proper research. And I'm saying sometimes, I just genuinely think when people ask me where to get ideas from, I basically read. Just do some reading. Reading's free and it's amazing. Just read up stocks and then connect things together and look at this. And the more you learn about company, and then so it's like I said, you were sort of banging the drum on equals. I'm doing it with a couple of other stocks as well, but it'll happen. The share prices start rising, then other people start paying attention. But why didn't you pay attention like 6 months ago or 3 months ago?
Yeah, I mean, again, exactly an example of that one, Justin, is your stuff on the electric vehicles.
Oh, I was a bit late on that though. Did you know what? The annoying thing was Ilika.
Not too late.
I know. Listen, there's still like 10 years at least of trend towards EV. I know, but the annoying thing is I had Ilika on the podcast, right?
Yes.
And it was literally, I think, back in the summer. And they said there were solid-state batteries, I thought, right. And I looked at their final results. And they could charge, 6 times faster. They hold charge about 5 times. They're non-flammable. I thought, this sounds too good to be true. And I did a British. I thought, that's good. They were based in Romsey. They were just over from, not far from where I live. And I thought,
they're a spin out of Southampton University, actually.
Yeah, exactly.
The same university that I went to, electrical engineering.
I emailed the guy there, Professor, who was the founder. And
it's Graham Purdy, isn't it? The CEO.
That's the CEO, yeah. But Professor Brian, I can't think of his surname, is the founder. But I thought, is it true that a company just down the road from me, a small company, could hold, what are the keys, which has been the problems to EVs, which is anxiety, range anxiety, and fast charging,
and flammable.
And flammable, yeah. And so, a big article in the Wall Street Journal. I don't know if you saw it on the weekend.
I did, I read it.
Basically, it was and I did a week previously. I did a comparison of. I said, right, here's Tesla. This is why they're the price they're at. Because how do you price in the future? And then you've got
they're only worth $700 billion.
Yeah. And then there's a company called QuantumScape, pre-revenue, do solid state batteries. And this basically article was saying that Tesla's batteries aren't as good as QuantumScape. That's the whole thing. Tesla's going to have to do something or change the solid state, even though Elon Musk, obviously he's not going to say that, but they're going to have to, if they want to improve the range and the charging and the safety, they have to go to solid state. And QuantumScape was there. Now it's just dropped a little bit in price. It's now only worth $25 billion with no revenue whatsoever. And there was a quote from Graham Purdy a bit further down. And this is basically what I did a week ago on my video presentation.
Yeah.
And he was saying, and if you look at the developments on their presentation, there's going to be no revenues from QuantumScape till 2026 pretty much. Now, Ilika's planned pre-production line goes into production in 2023, and they're getting revenues 24, 25. So they're even ahead of, and even Graham Purdy said, he said, our tech, I haven't seen anything from Quantum that's more advanced than ours. It's very similar. And so it looks like they'll be in production before QuantumScape. Of course, Quantum have Bill Gates and Volkswagen as backers. Ilika's got me. But I just think I've never seen a trend as strong as EV. Let's be honest. I don't know if you saw the car sales yesterday, but EV for the first time in the UK beat diesel sales. That's phenomenal.
Wow.
I know diesel sales dropped, but they're like off the forecourt in was it December or November? But off the forecourt, I think it was November. But there was 22,000 EVs sold, 15,000 diesel cars sold. And I thought, okay, diesel's had a hammering, but that's still a milestone. That's just, I mean, I think adoption of EV will be a lot faster, and the more money that piles into it, we'll get, the tech will be better, there'll be, bigger range, like solid-state batteries coming in, the bigger charging will be 5-10 minutes probably, and even less than that as we go on. But I think adoption will be faster now, because we realise, you can't buy, is anyone going to want to buy a car, in 5 years' time? that there'll be less support for, like a petrol diesel car, because that's what's going to happen. There'll be less investment in petrol
I've
diesel.
already said to my wife 2 years ago, the next car we're buying is electric.
Because there'll be more support for that, and the more infrastructure, and so I think adoption will be a lot faster, and I think this trend is a huge trend, and I had to have some exposure, so I bought TrackWise and Ilika. Ilika's gone berserk.
Did you recommend it just before it went from £1 to £2?
Yeah, well, I was slowly accumulating here and there, and my average was about just under £1, and then I kept saying I'm going to reveal what my second of my EV plays are, which I did. I revealed TrackWise first of all soon, but I said the share price has gone up. I'm going to come back down. It did come back down, but it didn't really go anywhere, and it kept holding. And I thought, this is very well supported here. It's not going to go any lower, I don't think, but I thought it was going to go lower. But it didn't. And then all of a sudden it started to move. I said, well, listen, I'm going to say what it is because it's starting to move. And so I said, it's Ilika. And it just went but nuts then after that because everyone sort of jumped on as well. And it didn't have, obviously not a lot of loose stock around. And it just pushed it up. But I mean, it's going to go. Sooner or later it was going to go. But they keep their head under the. I just think its nearest rival, which they're going to be producing faster than, is QuantumScape. It's typical American. That's 25 billion in value. Now that's obviously super overvalued. But I say even if you look at Ilika, you say okay, 300 million is overvalued. It's very little revenue. But again. If it is one of the players, there aren't a lot of solid state players around. But as far as I can see, it's about 12 to 20 around the world. Yeah. So how do you put a price on them being one of the major suppliers? They're working with Jaguar Land Rover and McLaren and Honda. How do you put a price on the future? That's why Tesla's risen so much, because it's basically the future. That's the price of the future. And the PE will come down. Of course it will. At the moment, it's ridiculous on Tesla, but it'll come down as the share price sort of levels off and the earnings go up. So again, it's hard to value that kind of thing. But I just think, as a trend, you shouldn't be out of it. It's something you should have exposure to. Electric vehicle, batteries, all that. kind of stuff.
I mean, I actually thought that Wall Street Journal article proved that it was a massive endorsement of Ilika's technology. Because let's be clear about it, it's worth about, 130 million market cap business to get into a leading article in the US, the biggest US-facing financial or investment newspaper, along the sides of Tesla and QuantumScape, given that America is so advanced in everything EV-related, just shows you that actually they are one of the top boys in technology terms in the world. Because Wall Street Journal would have done their research and gone through and spoken to a number of business, and to come to a little business out in England, in Southampton, in Hampshire, is just a credit to the team down there. So
the fact they're working with like I say Jaguar Land Rover, Honda and McLaren amongst others says a lot. But and even in that report yesterday, I think it was out when the car sales figures came out. There's a guy from the Society of Motor Manufacturers saying we need 4 or 5, gigafactories in this country. So far, we've got one. We've got to get on this curve before. And I've forgotten the complexities now, but there's some kind with the EU. The deal they've done with the EU is that they can only source, I think, about 45% of vehicle and infrastructure outside the EU. But they have 3 years window or something to get the investment in there to sort this out. So they basically got 3 years to bring on some big investment into gigafactories, and they need about 4 or 5 factories here. We've got one so far. So of course, money's going to pile into it. So let's be honest, it's not a fad. Alternative energy, or non-petrol diesel is not a fad. It's going to be here for the rest of our lives. And there are other players, hydrogen, of course, but electric vehicles are the most advanced, aren't they? So
and I think your strategy of taking that sort of top macro view, what are the big, strong, long-term secular growth trends, and then dovetailing it with that detailed sort of like stock picking, means that you actually end up selecting companies that are are valued appropriately, lowly valued before they actually go pop. And that's quite a difficult one in the EV stroke green energy, because many of them have just moonshotted like Tesla and stuff. But if you select well, take the sort of tailwind of those secular trends and choose the right companies at the right price, then you eventually, as you say, if you're patient, then the actual price will move up to the value of that business.
Yeah. Do you know, I've had a couple of people on my YouTube account saying, I'm from America, how do I buy these? I've never had that with any other stock. And so they know out there their plays are overvalued. So they're looking for exposure.
Yeah.
And I think they are in the OTC market as well. I think.
Yes, they are.
Ilika are.
Yeah.
So I said I think they're on the OTC market. So but I don't know much about that. So but so that shows you the hype in America. People are looking for reasonably priced. Well, in fact, let's be honest. Compared, when we talk about traditional valuation metrics, sometimes you have to throw those out the window because the trend is so big going forward that you think, well, you pay what you have to pay. Obviously, it's not a bonkers price like 25 billion for a pre-revenue company, but a couple of 100 million market cap. It could be a lot bigger than that in the future. I mean, even I was comparing like even fuel cell technology, Ceres Power. They turned over 19 million pounds last year. Made a 10 million pound loss. They're valued at 2 billion. So you're thinking, that's how highly valued this kind of alternative energy is. So, there you go. So, So, I mean, I just think sometimes it was trends like that big, you've got to get exposure. Any other stocks worth chatting about?
No, that's great. I mean, it's been a busy sort of first week, and it's going to get busier with all the trading updates coming out over the next few days. I've had a few on the retail side.
Yeah. I'm looking for... Yeah, do you know what? I'm looking... I find it very fascinating that Boris Johnson's nailed this target of 13 million to the mast, because we know they've not been very good with targets recently. They dropped them halfway through, but that's a big target. So, and the fact that they're so confident, part of me thinks I don't believe it, but part of me believes they have to do it. And if they do it, we'll see this. We'll see the hospital admissions coming down, plus with the lockdown. So I think, listen, and we should see it within a couple of weeks, I think, and hopefully, as long as. What I just heard, I don't know if you heard about this today, but apparently lots of parents are sending their kids into school because they said they're key workers, a lot more than for the first lockdown. How can you become key workers all of a sudden? Apparently, so some as a guy on Radio 5 Live today say apparently his classrooms are 60% full. so it's like, which is not going to help, infection rates, is it? Because
I'll tell you actually one thing. You just make a very good point actually, because top level. For investors, fear is your friend, as we proved back in sort of March and April time. If I mean, it sounds as you and I on the same view. We're not going to sell any shares. If anything, if there's opportunities, we're going to deploy more cash and look for buying opportunities. If over the next 3 months there is a bit of volatility, some nice companies that you like fall down in value, in the share price, but the value hasn't decreased, then that's the time to buy. I mean, it might be your last time this year if you get a bit of effectively favourable volatility, because the outlook for the market, the world, and for the long-term trends, it is positive. It's just timing.
No, I think we'll have volatility, because what we'll have is this euphoric rise, maybe on the economy opening back up, then realising, hang on, the economy's in tatters a little bit. It needs repairing. It's not good. It's not ready to run. It's an ill man. It's just getting out of a coma basically. So it has to build up. So I think then once we get over the initial euphoria of the economy opening back up and the vaccines working maybe, then we'll think, hang on, there's a lot of companies here now got extra debt. They haven't got the markets they used to have. So I think then we have a bit of a sell-off,
Well, equally, a lot of people have got cabin fever, haven't you? We're all being locked up for 9 months. We're desperate to go on holiday and spend some money.
My missus is like booking. I think she tried to book about 5 or 6 holidays this year. I thought, calm down, and that's it. I think so. I think people will want to get out and eat, in restaurants and all that stuff, and visit escape rooms.
Exactly. Anyway,
marvellous.
Thanks a great weekend, guys.
You too, by the way. If you want to get on YouTube, hit that subscribe button, notification bell if you want the next one to your inbox. Cheers, Paul. Speak next week.
Yeah, cheers, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Russ Mould, Investment Director at stockbroker AJ Bell. You all right, Russ?
Yeah, I'm all right. I'm in good health, Justin. Happy New Year to you.
Yeah, Happy New Year. And the market, the index, the FTSE is looking very good, is it? And very positive. And
it is. I mean, given the backdrop. I mean, I did a couple of broadcasts right at the end of last year on the radio and was talking about how the markets were relatively calm. And I got trolled for it on Twitter, saying, well, that's all you're interested in. Well, the answer is, please, I can assure you it's not all I'm interested in, but it's all I get asked about. Yeah. So when I give answers, it's looking at things through the narrow prism of financial markets, because that's what people talk to me about. But clearly, it is difficult to understand in many ways how you've got the economic and the health backdrop looking so difficult, again, relative to stock markets that are so bouncy. I mean, the UK last year, stock market was basically the worst global major index performer, down 14-15%. in local currency capital terms. I mean, the Nasdaq was up 40, China was up 20 odd, Japan, America were all up in the teens. So the UK was again a hound last year.
And what was holding it down? I suppose Brexit and obviously coronavirus for everyone, but we had double sort of pressure, didn't we?
Triple. You know? Well, in the end, we had two things that everybody had, which are coronavirus and a recession. Mm-hmm. Though, you know, if you look at the statistics, you can construct a case that the UK maybe didn't deal with coronavirus as well as some other nations, like, say, the Asians. Yeah. And it had a deeper recession. Mm-hmm. And also we had the Brexit thing. So if you're looking to accentuate the positive, you can say, well, okay, we've now got a vaccination program going. Yeah. We've come out of recession. And the Brexit thing, we kind of know where we stand, at least when it comes to manufacturing, and they're promising a services deal in the first half of the year. So you can argue that the three things that were the dead weights last year won't be dead weights this year. Mm-hmm. You can also argue that, and the FTSE 100 index is a very, as we've discussed before, is a very funny index, in that it's packed with oils, banks, miners, and insurance companies. And after that, it's kind of the next biggest contributor is consumer staples, which at least brings a little bit of stability to proceedings. Yeah. But it doesn't have much by way of technology. So if you look at what people were really interested in generally across last year, it was tech, it was secular growth, it was economically relatively insensitive businesses. Well, the FTSE 100 just doesn't have them. Or it's got the consumer discretionary, but mining very cyclical, oil collapse in the oil price last year, plus secular concerns over long-term demand. Banks' profit margins being crushed by zero interest rate policies and quantitative easing in fears of bad loan losses. Insurers, similar concerns over the yield curve and the returns that they're making. So really, the FTSE 100 is an index that is not well built to withstand the sort of problems that we had last year, but equally it's very well built to capitalise upon any global upturn and any return of inflation and any increase in interest rates and steepening of the yield curve. So in that respect, it's underloved, it's underperformed. You could argue it's potentially therefore undervalued, and it's actually kind of a cyclical recovery growth / value, for want of a better turn of words, play. And that's why it's actually started the year quite bouncing. And we talked about back in the autumn how sentiment on oil stocks was completely bombed out. And I know there are all sorts of ESG issues, and there are lots of people who will just walk away from them on environmental or governance or ethical grounds, and I completely get that. But there are plenty of investors out there who just want to protect wealth or make money. And, you know, we said back in the autumn, it isn't going to take much to get oil stocks going up, and they're up about 35% since. And the oil, and so again, the FTSE 100 is in that respect capable of springing a bit of a surprise. And we've had bids for RSA and Entain, FTSE 100 companies in the last 3 months. There's been about 15 other bids in the 250 and below. So somebody somewhere thinks there's a little bit of selective value out there. And so it is hard to explain to people why the market looks so bouncy when everything else doesn't in the real world. But it's because markets are forward-looking and they're trying to price in the better. And also, you know, things that do badly for a long time can just be too cheap. And in the end, it's almost you need to try and buy at the time of maximum pessimism, not the time of maximum optimism, because that's when you really get into trouble from a financial market point of view.
Yeah, do you know what? We look back at that, Dash for Cash happened back in March when everything was going to lockdown. And maximum fear. I think the fear greed index was down at 2, which is, I've never seen it that before. And looking back at any stock, even the big stocks, you could double your money on pretty much if you'd bought at the height of that. So you realise fear is sometimes, if you've got cash and you've been looking at a stock and you quite like the company longer term, it really is an opportunity, isn't it? And if you look at now, like I said, oil. Let's take oil for a good example. Like I say, FTSE, a lot of oil companies there, but like it's been hammered on both levels really because ESG concerns and like you say, the lockdowns, less demand, but that demand's going to return. Okay, it may not return forever because we've got now EV adoption coming on quite strongly, but it's still going to take a decade at least before demand starts to So they were oversold, weren't they? Definitely, And
I think this is Shelley, Yeah, I think this is the issue. No matter how much we'd like to think we're going to step away from hydrocarbons, it's not going to happen overnight. Yeah. And, I mean, if you look at the latest OPEC survey, it still says that oil and gas will be the biggest source of energy in 2045. Now, we need to consider the source there, because OPEC isn't going to write a document that says, actually, we're entirely irrelevant in 25 years' time. But nevertheless, it is going to take time to get, renewables going, or nuclear, if that's what you think is part, or whatever it happens to be. And so, if there is an upturn, and the global economy rebounds this year and 2020, oil demand's going to go up, full stop. And at a time when OPEC is behaving itself supply-wise, you've got a potential. I assume we've now got a Democratic president coming into the White House who is anti-shale and anti-fracking. So that's going to put the clamps on a big source of supply there. And at the same time, you've got the oil majors all holding back capex and not looking at new projects because they're being told not to. And then you might have an upturn in demand. Normally, it'd be a perfect setup for oil companies. Again, there's the ESG overlay, which is lots of people just don't want to know, and fund flows are very strong into ESG funds that exclude those sort of stocks. But under normal circumstances, you'd be getting pretty excited about oil companies just because you can see where there might be a setup there for sentiment to turn and it's done a little bit, but it could still go an awful lot further. The danger is that BP and Shell are looking to reinvent themselves, and under such pressure to do so, there's a fair real chance that whatever they get involved in, they're going to overpay for it. Yeah. So there are some issues to be addressed there as well. But I think under normal circumstances, I would be very excited about oil companies. Where at the moment, I suppose I'd probably say I'm kind of interested, but aware of the backstory. But if you look at why markets are going up, again, it's because of more broadly, it's fiscal stimulus, it's monetary stimulus ongoing, vaccination hopes, this bubbling understory of inflation that we've discussed before, where we've seen commodity prices start to go up, we've seen people, and also just this issue of some investors just look at Biden coming in, and they look at Congress already talking about more stimulus after the programme in December. They look at the UK government, it's been handing out more aid this week, 4.6 billion from Sunak, effectively £2 billion of state aid to international and consolidated airlines, you could argue. And so they're looking at, well, there's just going to be more money printed. And so some investors are just looking for places that will protect themselves from what they view as debasement of currency. That means owning real assets, commodities, or assets that can produce cash, which are things like equities. So in that respect, you can understand it, even if, again, from the outside, it looks very strange. I think the wall of money argument, I don't generally like them very much, because you're sort of betting on other people just pouring money in after you. But at the moment, there is so much money out there with fiscal stimulus, monetary stimulus, money supply running at growth at 8% in Japan, 12% in the UK, 25% in the US. It's classic bull market stuff. It's too much money chasing too few assets, and Bitcoin is the ultimate example of that. 21 million units of Bitcoin is the max. There are 18.5 million in issue already, and you've got a tidal wave of money chasing after it. So finite supply with infinite amounts of cash chasing it, well, you can kind of see why the price has done what it's done. So what you're looking to, if you are getting nervous, and let's face it, I won't use it, this is a family show, I'm sure, just since I've got to rethink of how I phrase this, but Barton Biggs, the Morgan Stanley strategist, who was brilliant, unfortunately he's now at the great stock exchange in the Sky, I will try and rephrase it so it's more decorous, but he said, some of the things that you enjoy the most, experience-wise, feel their best right at the very end.
Yeah.
Does that make sense? Well, you're a 100-meter runner, or you're a marathon runner. You've got to the end, and you've got this massive adrenaline rush. You've done this amazing thing. It's like, oh, fantastic! But then it's over, and all of a sudden that adrenaline high goes bang straight. Or you watch your team win over 90 minutes, or extra time and penalties, and there's that massive adrenaline high right at the end when the final winning penalty goes in. And then within half an hour, the adrenaline's all in your socks, and you're crawling around on the floor. And bull markets are like that as well. They feel their best right at the very end. So that's why you've got to be, again, wary of that point about maximum optimism, maximum pessimism. And when there's maximum optimism on that fear and greed index, that's when you've got to be a little bit careful. And I think bull markets end when the money runs out. So the question that you've got to ask yourselves, dear listeners, is what's going to make the money run out? Where's it going to go? And the example that I always think of here, and I was talking to my colleagues about it yesterday, was I remember seeing it when I was at my investment banking days. I saw a hedge fund manager in New York, and again, I'll make this a family version because his language was pretty peppery. And he was saying that Gordon Brown, the then UK Chancellor of the Exchequer, came up with the idea of selling 3G spectrum for mobile auctions, if you remember it, and the UK raised over £20 billion.
Yeah.
And then every country around the world thought, well, this is brilliant. It's just free tax dollars, so let's all do it. And so all this money went into spectrum that was then grossly overvalued, and strange enough, then the money disappeared. And so this fund manager said to me, well, it was all you British's fault, the collapsing of the TMT bubble, because your government got rich and everybody else got murdered. Everybody else got hammered because the money was wasted. Yeah. So that's what you're looking at, is where's the money going to be wasted, or where's the money going to go? And the other thing that was happening in 2000 particularly was all these fancy pants internet.com companies with no money, no revenues, and a massive valuation surprise, surprise, 180 days after the IPO, management and the venture capitalists and private equity backers, they were selling everything they could lay their hands on. And they didn't care what price they were selling at, because their in price was nickels on the dollar. So again, people were mugged into buying at the top when optimism was maximum. So what you've got to be careful of this year is a deluge of IPOs and a deluge of secondary offerings, a deluge of more SPAC deals, for example, deluge of M&A. They're the things you've got to be careful of, because we've actually seen de-equitization over the past years, with dividends and buybacks outstripping equity issuance. So when you start seeing equity issuance from management teams or secondary sellers or primary sellers massively outstripping flows, that's when you're potentially in trouble. It doesn't feel like it's going to happen straight away, but I can guarantee you eventually it will do.
Mm-hmm. Yeah. And do you know what? Just going back to thinking about it as well, when we talk about macro and we talk about indices, but I'm always reminded that it's a market of stocks, and like you said there, and like you said there, not a stock market, and thinking about, we have to sort of separate oil from oil companies, because now they're not oil companies, are they? Like you said, they're not going to stand there and take it, because I think, is it BP owns the biggest electrical EV charging network in the UK? They bought that a while
Something
back.
like that, I think. Shell's got a big battery business, and actually I write a column for a national newspaper, and a reader wrote to me this week saying, Mr. Mould, you've only talked about oil. Shell has pivoted to gas after the BG deal. And I said, you're absolutely right. Yeah. And they're looking to redevelop the strategy. But unfortunately, stock markets are very crude things. Shell is an oil major. And if you look at the Shell share price against the oil price, take a look. And, and unfortunately, markets will trade off perception until something intervenes to change that perception. Now, Shell is a big play on LNG. And LNG prices have quadrupled in the last 4 months. So that's not going to do any harm either when push comes to shove.
It's wonder, you think you're going to hire some sort of, rebranded agency for lots of money to sort of come up with, because they have to decouple from the oil price, sooner or later, because, it'll get to the stage where, yes, of course, they are highly leveraged to it, but they're trying their best to get away from that and go towards clean energy and gas and all that stuff. So when will the perception of the average investor realise that Royal Dutch Shell is not oil,
I think it's going to say. I mean, Next has achieved it as a retailer. Yeah. It used to be seen as a purveyor of clothes through bricks. Yeah. Now, more than half of its business is online, and the share price is higher than it was a year ago, despite everything that we've seen on the UK high street and in the UK economy. So it can be done, but there was a negative perception that Next had to overcome. And in the end, what persuades people is profit, cash flow. Ultimately, and they can see your business mix. So obviously Shell, big company it is, annual revenues of X $100 billion, it's going to take some time to move the dial with its other businesses. And the quicker they move, again, the more likely they are to overpay for something. And I suppose, again, that's potentially one of the dangers you'd look for from the specific stock or indeed wider markets is, bad deals that are overpriced, in the end, is where the money goes, and that's when the money does run out in a bull market. But there's so much of it around at the moment, you can see why markets feel like partying, despite everything that's going on.
Well, exactly. So we got this, it's always been said, the light at the end of the tunnel with the vaccine coming out. And everyone seems to think that, this year will be a mirror image of last year, where last year the first quarter was good, the 3 quarters were terrible. And now we're going to get, a bad quarter, first of all, as far as the real economy is concerned. Then an opening up, like you say, stock markets look forward. So they're looking towards that second quarter, third quarter and fourth quarter. And but part of me thinks sometimes, things don't run as smoothly, or they're not easily as predicted as we think, the masses think. And I think we will have that initial euphoria, I believe, when the vaccines and hospital take effect and the hospital admissions come down. But then we'll have an economy which has been war-torn, is shot to bits a little bit, and there's a bit more debt on the balance sheets, and there's less demand, straight off, and it'll be a slow recovery, I think, till we get back to where we were pre-COVID,
I think it depends on how quickly the vaccine is rolled out. I mean, speaking from personal experience, I cannot wait to get back out in the real world. I want to go and have some fun, see my friends. And so, if it's a matter of giving people the confidence to do that. And one thing that a friend pointed out to me yesterday was that South African radio and television every day talk about the number of people who've had COVID and survived it.
Mm-hmm.
I mean, it creates a different narrative. It's the same data, but you're just creating. I'm the data is the data. What's happening is not nice. And if you've got somebody who's, you've got a relative who's ill, it's really not nice. But at the same time, from a wider population perspective, if you're being beaten over the head every day with words like mutation and death, it's going to create a very different mindset from one that's like actually, yes, X people have had it, but 97, 98, 99 people have got through it and got past it, and they're absolutely fine. Thank you very much. So I think it is. Some of it will be science. Some of it will be perception and presentation and narrative. And I think it will be about giving people confidence.
Yeah, it is. Because like I said, the vaccine is not going to make it go away. All it does is manage it, and as soon as we get the NHS sort of under control, it'll be fine. Then we can open back up. Because like I said, people still get vaccinated by the flu, and lots of people still die from it. So we're less worried about that, and because it's older and it's not so new and it's not so novel, then people tend to put up with that and accept that. Accept that risk, but. The risk and media, of course, that's good actually. So try and flip that maybe and say how many people survive from it, and it does because they're positive.
I'm not saying the media are doing a bad job. They are doing their job and they are presenting the facts, and there is no slant on them. We know it's difficult out there, but I think at some stage we're going to need to try. When the vaccine is buzzing along, I think a part of the equation of the recovery is going to be confidence. Yogi Berra, the American baseball player, said, baseball is 90% mental, the rest of it's physical. And, it's like, recessions and upturns and inflation, and a lot of it is psychological. It's how people are feeling. And that's why economics is such a difficult subject, because so much of it is about how people behave, which is entirely unpredictable. So I think at some stage the government, once it's got its science dots in order, I think we'll need to start thinking about how to just try and move the narrative on so that people they are terrified and they are given confidence to go back. I think some people will be wary. I think some people will be like, I just want to get out there. And so I think you're right. It will depend a little bit upon ultimately how people respond. I think initially there will be some caution, but thinking about how quickly people got back to flying after things like 9/11, I think we might be pleasantly surprised at how quickly people want to get back out there if they get a chance.
I believe that. My wife's gone crazy trying to book holidays, and because we've missed lots of holidays. We like holidays. It's one of the things we like, and I think, and to be honest, there's some good deals out there. And I said to her, well, I don't think they're going to be around that long. In second quarter, if this goes to plan, I think the holiday companies want the money, and if there's lots of people going for a certain amount of spaces, a finite amount of spaces, obviously it's supply demand. It's going to go up.
And that's the inflation narrative, right? You've had supply side destruction. Mm-hmm. Those people who've been lucky enough to keep their jobs, not be furloughed, have actually probably been saving money and are better off because they're not commuting or anything else. Mm-hmm. And so you can. That's one of the inflation narratives that's out there, along with money supply and so on. That you might get a bit of a mini boom as there's this enormous sense of relief breaks out. Mm-hmm. I mean, they're equally the counter argument is that you've had demand side destruction because you have seen unemployment tick up. You have seen people lose their jobs. Some businesses will go bankrupt. And so it's finely balanced. But my suspicion is you might end up with a bit of a mini boomlet when people really do feel confident enough to get back out there, as we all hope they do, if not this year, then certainly next year. Yeah,
I think so. All the stuff, let's hope so. And
definitely. Well, that's the most important thing is just for everybody's health. Yeah. Let's hope so. Financial markets will take care of themselves. They're greedy things. They'll do what the hell they want to do. But from everybody's mental health and physical health perspective, let's just hope everybody can get out there and enjoy themselves and see their friends and relatives again.
Marvellous stuff. Russ, thanks for that. And we'll speak next week.
I look forward to it.
OK, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Immediate Group, up 8.2% to 33 pence. At 4, First Group. That's up 0.95%, 1%, let's say, 80 pence. At 3, Remote Monitored Systems, down 2.4 to 2.85. At 2, Mode Global Holdings, it's up, 6.35% to 67 pence. And again, Argo Blockchain Mining, wow, it's up again. I remember covering that. I can't think where I covered that, but some ridiculous price. I think it was like 5-6 pence maybe on videos. Now it's £1.37.5, up 10% pretty much today. OK, of course, blockchain power. Where's Bitcoin at? Bitcoin's still rallying. Let's have a check where that is. It's $41,000 now per Bitcoin. Just keeps going. And of course, sooner or later it'll top out. But it'll keep going until it tops out, of course. OK, and top 5 most read RNSs are as follows. At 5, Zoetic International, commencement of trading in OTCQX. At 4, Immediate Group, placing and subscription to raise 3 million. At 3, Alba Mineral Resources, Clogai, St. David's Gold Mine update. At 2, Ectech, Noblis of Greece, MOU, and growing Iwegi partnership. Apologies, I don't know how to pronounce that. And at 1 is Remote Monitor Systems, Director Option exercising total voting rights. That's it for the podcast. Thanks for listening. Muchos appreciados.
The Vox Markets Podcast. With Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.